right, so with that, I'm going to introduce Kirk Michie, who's our speaker this morning. Not only is Kirk a friend and a wealth of knowledge, he's also my brother-in-law, so be nice to him, please. I'd appreciate that. Otherwise, it's going to be a very rough Thanksgiving dinner. But we have a lot of really good topics to touch on today, so thanks for being here, Kirk.
Yeah, thanks.
I'll let you start with your introduction of what you do and Candor Advisors, and let's kind of start with that, then we can jump into our questions.
Okay, sounds good. So I'm Kirk Michie. I'm the managing partner at Candor Advisors. We provide transaction advisory services to successful founder-led businesses. That takes a few different forms. Typically, if somebody is thinking about selling their business and they feel like they're close, then we often make introductions to the right investment bankers and help them build the rest of the deal team, including getting the right M&A attorney involved, getting their financials up to speed, kind of supplementing that activity. If they're more like 2 or 3 years away, we kind of work backwards from what the buyer's due diligence lists look like to find the areas where they can enhance the value of the business, and probably more importantly, protect against the risks that are going to cause their deal to maybe fall apart or get valued for less when they go to market. And then the third leg of the stool is, kind of resolving conflicts within business. And that doesn't mean that we do conflict resolution per se. It's just that oftentimes if, co-founders are misaligned, like maybe one's a lot older than the other one and wants to exit, and the younger one can't buy the older one out and doesn't yet want to exit, there's a capital solution for that. There's a lot of capital providers out there. Sometimes we involve investment bankers in that process, and sometimes we just work out a solution internally. As you might imagine, we're really busy right now. I don't think anybody who's involved in the business of transferring ownership or control of companies isn't busy right now. So we're working on a number of deals. I'll probably reference a few of them in response to questions, but it's really good to be with you this morning. Thanks.
So just as a show of hands, how many of you are business owners? I think the majority of folks are here this morning, right? Yeah, very good. Okay. I'm curious, have any of you been approached over the last 12 months of just an unsolicited email or phone call, whatever? Hey, I've got an investor. Hey, I'm part of a private equity firm. We're looking at rolling up and acquiring companies in the industry. Would you be interested in selling? Has anybody received that? I'm getting about 2 a month also, exactly. As soon as I tell them what my EBITDA is, I never hear from them again. But I'm very transparent. I'll say, I know where I need to be to really truly be on your radar screen. I'm not there yet, but I'm driving there. So it's interesting, to have those kind of dialogues. So maybe you can give us a sense for what, I know you were kind of mid-market is a lot of your focus, but maybe you can give us a sense for what you see as the buyers, kind of appetite, if you will, for smaller companies and what they're looking for.
Yeah. Well, first I would say at least you know what EBITDA is.
True, exactly.
Right. For what we see a lot right now is that there's a few factors that sort of propel all this M&A activity. The first one is that baby boomers have been a really entrepreneurial generation. So there are a ton of those businesses that in order to facilitate retirement for the founders, it's either going to need to be an external sale or an ESOP or a management buyout or something like that. And in almost all those cases, there's going to need to be outside capital. So that's part of it. And we just happen to be, kind of in that, kind of mega trend right now. The other piece of it is that capital's cheap, whether you're talking about equity capital or debt capital with interest rates as low as they are. Private equity, which rebranded about 15 years ago because leveraged buyouts had kind of an icky, kind of vibe about them, but it's the same business. It's somebody essentially buying your business like we all buy houses, right? Some equity down and then some borrowed money to complete the transaction. So there's all of that. And then there's right now, there's about $1.5 trillion, maybe more dollars in what would be called dry powder, committed but uninvested capital at venture capital and private equity firms looking for deals. And because the pandemic took a lot of people, it took all of us by surprise, but what it did for private equity firms was cause them to have to first do kind of portfolio triage. Any of the businesses that were impacted by that they had to fix and decide whether they were going to inject more money into them. And what that then also did was cause them to not be out there looking to deploy funds. So they were about a year behind. They're in a big hurry now because if they don't deploy the capital, they have to give it back to investors. They have a window in which they have to invest the money. So you got that. And then the last piece is that it looks like capital gains taxes are going to go up next year. And so anybody who was thinking about selling this year accelerated their time frame. Now, for anybody who's not in a deal right now, especially if your company is over about 93 million in value and you got to do an HSR filing with the Federal Trade Commission to look at whether it's an antitrust deal or something like that, there's no chance you're getting a deal done this year. If it's a relatively small deal and a simple capital structure, it could still get done. And you should be talking to Tim Malott back there.
Right, exactly.
but you know, so all those factors combined make for a pretty frothy market.
James?
I was just going to ask, are you talking capital gains in general or capital gains just for businesses?
Yeah, so capital.
Yeah. So capital gains taxes in general, you know, the current proposal has them going up by around 5%. They're probably not going to go up to kind of ordinary income tax rates, and there's still some wrangling to be done. And I mean, it's the kind of issue that one has a lot of ideological, you know, kind of back and forth to it as to why that's happening, what it's funding and all that. We try and stay out of that conversation. But what it does is mean that depending on deal structure and timing, the economics of selling your business change a lot between doing it this year and next year. You know, and I am personally fairly liberal, but I will tell you that I don't think that it's fair. And by the way, it doesn't matter what I think, but I don't think it's fair that a business that you've built over 20 or 25 years gets capital gains taxed at sale the same way somebody who bought stock a year and a half ago in the public markets did. But that is what happens. Same thing as if you buy public company stock. Absolutely. And you're seeing, I'm involved in transactions right now where people are trying to calibrate whether it makes more sense to move to Florida, Texas to avoid 13.3% California taxes and pause for the 183 days it takes to create, you know, residency in another state versus the 5% bump in capital gains taxes.
So you can do that. You can actually, as long as you're in that other state for a minimum of 6 months or just over 6 months.
Well, you know, I would stop short of giving tax advice. I would say that the
qualifier,
attorneys
consult your tax.
Yeah, right. And that is a good idea because while there are a lot of tax elements that might weigh even more heavily on a transaction than this one, like whether you're taking all cash, whether you're taking stock and cash, how much stock you're taking, whether it's, you know, public company or private company stock. There are a whole lot of factors that impact that. But the tax lawyers that we're working on, one of the transactions I'm working on, are advising this seller that he needs to show that he spends at least 183 days a year in that other state to prove that he's a resident. He also needs to show that he gets all his mail there, that his ATM usage would bear out that he spends 183 days in that, because California and the Franchise Tax Board is one of the most aggressive state tax agencies, and maybe even more so than the IRS. They will hunt you down.
Do they use subpoena your phone records to see?
Practically, yeah. It's pretty, you know, it's pretty onerous. It's a tough test.
So at the end of the day, even, and I'm not sure, maybe this was the case in 2017 when the lower taxes passed under the previous administration. I don't know if there was a lot of people that started, you know, thinking about selling back then. But in most cases, I would think that, you know, the tax ramifications are an afterthought. That's not the main driver to somebody wanting to sell a business. We were talking to Leanne earlier, and she has a client that are in their late 70s. And so, yes, taxes will be part of that conversation, but the main driver is that they want to retire and move on with their lives, I would imagine. So is that, by and large, is that true, or is that kind of naive to say that the taxes don't really drive that final decision?
Yeah, so it's a great question. I would say that for most people initially, it's not a big consideration, because I don't think most people know how little of the gross proceeds they're going to get to keep when they kind of run through all of this. It becomes a pretty significant consideration when the transaction advisor or lawyers start to do kind of a pro forma net proceeds analysis. And there, I think, it's useful to be thinking about reasonable assumptions about, what tax rates are going to be, how much your net proceeds are going to be, what kind of investment returns are reasonable to make on that money, spendable investment returns, so after tax investment returns, and what your life costs. Because we've seen a number of transactions, there's 6 of them in the last 18 months, where our guidance to the sellers was, developing a successor and kind of becoming a limited partner in your business and taking distributions from it probably makes more sense, because the way that buyers are going to value your business, it won't be enough to replace kind of the lifestyle you live in right now. It's hard medicine for a lot of people. The other thing is that, we probably talk about ESOPs 20 times for every one we see gets done, but the tax advantages of doing an ESOP, even though you're selling your business at a lower number than, say, an outside buyer might buy it, on that net proceeds analysis might be helpful. Because if you take the proceeds of an ESOP sale and you invest them in what's called a like-kind corporate security, and there are a bunch of them out there that issue these kind of perpetual or 70-year bonds, you put the money all in that, you borrow against it at a pretty low interest rate, less than 1% of total cost drag, and then reinvest that money, then you're not paying capital gains taxes on the sale. So there are some alternatives to just an outright sale. But Leanne and I were talking about before, so many people right now have this kind of fear of missing out. It's sort of like if you own a business and you're not getting phone calls from, private equity firms, and understand when you get the phone call from the private equity firm, you're not talking to a decision maker. You're talking to an associate trying to develop business for the firm. But, a lot of people are now sort of thinking, geez, maybe I should be thinking about selling. And, look, I don't know how long this lasts, but it ain't gonna last forever. And I don't know how long it takes to come back. But there is definitely a, kind of a good reason to consider sale right now, but there's also a whole lot of good reasons to kind of pump the brakes a little bit.
Yeah, Leanne.
Can you talk a little bit about how common it is for somebody who's buying the company to put in the handcuff deals of either clawbacks if the performance isn't as expected, or that they have to stay on for management contracts, or if they come back if the team isn't where they expected them to be?
Sure. I'm going to repeat the question just so our virtual audience can actually hear the question as well. So just about kind of clawbacks, or about, kind of earnouts, or consulting as an owner selling, does it make sense, or is that even plausible to stay and expect that from the buyer?
Yeah. So it's not only common, it's persistent in every deal. It's pretty rare that there aren't some pretty significant whether you call them clawbacks or restrictions or non-competitive elements, in a purchase agreement, there's an M&A lawyer that I work with a lot. They'll say, the terms of your deal probably only take a page or 2 pages. And then there's 85 pages of how they can take their money back. So, one of the things that's really, really important for anybody who's thinking about trying to do this on their own, or to save money by not using a transaction advisor or at least an M&A attorney, is, understand that your buyer is a full-time predator and you are part-time prey. They are better at this than you. Their junior analysts have looked at 20 deals in the last 2 months. And, if you've been involved in 2 business sales, you have 2 data points of experience, right? So don't believe that you can save money by doing this on your own. I mean, you can, but you'll never know how much you left on the table, and you'll never know which terms and conditions, are going to come back to bite you.
Until it's too late.
Until it's too late.
Right,
We see it. We see it.
Sure. Wow. And then in terms of, you talked about ESOPs, for example, is there a certain revenue threshold I don't know if it's EBITDA or if it's revenue, where an ESOP makes sense, where you need a minimum floor, if you will?
Yeah, so I think there are, so we usually, when somebody is open to the idea of an ESOP, we bring in an ESOP consultant.
Okay.
Because there are a lot of regulatory elements, and you do need to get formal valuation done. And, you need a fair amount of professional advice from kind of tax, legal, and valuation to kind of figure it all out. So there probably are.
Okay.
I just don't know.
Okay, gotcha.
Yeah.
Okay. Questions? How are we doing? Good? Okay. So given that a lot of us here are business owners of small companies, I would say, kind of use that term broadly, the biggest, challenge that I have as a business owner is trying to figure out, I guess two challenges. How to get out of my own way, right? To set up the business for success and a potential sale down the road. And B, how do you do that while you're still actively in the business, right? You got to kind of work both sides and walk that fine line. Maybe you can touch on some pitfalls that you've seen owners fall into, and then maybe some good examples of things that owners have done that have really helped to catapult that value for an eventual sale.
Yeah. So it's a great question. And I have a certain amount of humility about the fact that I'm sitting in this seat right now answering this question, but there are people that are probably better able to answer this operationally.
Sure.
What we see from a transactional perspective is that the businesses that have what I would call, as you're heading into management presentations or as you're talking to the founder about the business, where the business owner has what I call Ozzy Osbourne syndrome. That's a hard business to sell, because that person looks like they're so vital to the business that the buyer looks at them as a risk factor, right? And so if you want to sell your business and ride off into the sunset, then the discussion in the management presentation shouldn't be how important you are to the business or how vital you are to the top 5 customers. So there's a couple of pieces to the answer to your question. One is the scaling element, right? Like, how do you, put decisions in other people's hands and empower other people to lever up what you've started? Because you're going to get paid for that, but it's going to be uncomfortable. There's like your impulses, your sort of your instincts and your impulses made you successful, but impulses don't scale. You have to figure out a way to scale that's going to be uncomfortable to you. And, there's outside help for that. There's I know a lot of great, Vistage chairs that also do, kind of work on the side as consultants that can help with scaling. And all of that comes back to you in the form of higher multiples, because personal services businesses or businesses that are largely controlled by, an individual sell for single-digit multiples of their economics. And by the way, I'm not talking about high single digits here. I'm talking about, like, if your business does less than $1 million of EBITDA and you're really, really critical, you might sell for 2 to 4 times that number, depending on, who the buyer is. And that, for most people, is not going to cover the fact that, like, if you run a successful small business, you probably take at least half of the EBITDA home yourself. So, getting 2 to 4 times that number is not going to support your lifestyle. Now, if you're burnt out, you no longer want to be in the business, or you see competitive threats that are going to wipe you out, then sure,
it's a different motivation.
Yeah, that's a different motivation. And that gets to another piece in the question you didn't ask, but like, having a pretty clear sense of your why in selling is really critical, because there's going to be a point in time where you turn to your investment banker, like Tim back there, and you say, is this a good offer for me? Or which one of these 2 offers should I take? And unless you've shared your real motivation to get out of the business, it's pretty hard for a transactional professional to tell you whether the, one offer, just because it might have more cash up front, or, a better kind of management package for you, really meets your why. You kind of need to kind of go inward and think about that, because chances are structure can answer that better than price.
Interesting. Yeah. It's so funny. We're all so kind of inundated with the why about our business. Why us? How do we differentiate? Why are we better than our competitors? That whole Simon Sinek why, right? I never even thought about really much about the why of selling. What's the motivation? It's not just taxes. That may be third or fourth down the list,
Yeah.
but it could be burnout. It could be competitive disadvantages coming down the pike. It could be a lot of things.
I worked
That's a
on
good
a
point.
deal when I was still a financial advisor where I had introduced the seller to the investment banker, his M&A lawyer, the accountant that did the quality of earnings. And so I was this guy's most common kind of go-to, like, what should I do about this? How should I think about that? And he had told me when we first met that if he didn't get at least $20 million for his business, then he wouldn't sell. And he had paid himself $1.2 million in distributions the year before that. So I said, well, I'm not even sure $20 million will replace the economics of what you're paying yourself right now, because you've got to give your partner some of it, and then you've got to pay taxes. And he said, well, 20 million's my number, right? I told him that he didn't think he should sell. I thought his business was worth 14 or 15 million dollars the way it was. So he came back around, he decided to sell. We retained an investment banker. The offers started to come in. And the initial bids were, in one case, 18 and a half, in another case, 21. And so we were there. We were pretty close to his number. And he was looking at the net proceeds analysis and saying, I just don't think this is worth it. And I said, well, maybe, this is, now maybe we should have the conversation about your why.
Yeah.
And so he starts talking to me, tearing up about the fact that he misses his son's Little League games regularly because he has to work on the business. And he agonizes over meeting payroll in between, kind of periods of time. And that he'd really like to be more involved in his faith community. I'm like, so what does $20 million have to do with any of that? Right? Now this story has a great ending, because the investment banker was actually able to get two private equity firms to start bidding against each other, and he ended up getting $30 million. And so it checked all the boxes anyway.
So it helped being in that faith community. A lot of praying happened. And
Yeah, he put his faith in something up here, and then a really smart transactional professional, and there just happened to be, but he was, by the time it ended, and I'll tell you, this guy, first of all, he continues to be one of the most extraordinary people I've ever met. He gets the money wired into his account. A week later, I call him and I go, so which bucket list items did you buy? And he's like, Kirk, I already own a Tesla. We live in the house that I wanted to live in. And I'm like, so you bought nothing? You did, like, you got all this money in your bank. He says, I paid off my parents' house and my brother and sister's houses.
Wow.
That's what I did with the money.
Nice.
Right?
Talk about a pretty compelling
He's
why.
an extraordinary guy. Yeah.
Wow.
Yeah.
Really good. Good. Questions? How are we doing? Yeah, James.
When you are going 2-3 years out to help someone with their exit, are you looking at ways of boosting up the revenues and then maybe making that one person less important to increase the EBITDA?
Yeah, absolutely.
So kind of question around kind of what do you do 2 or 3 years out to start to prepare, right? And make yourself less, not less important, but less, as the only important person in the company.
Yeah. Well, you do, and you do actually make yourself less important.
That's
You
true.
make yourself less vital to the business for sure.
Okay.
There's a wealth manager in town that I've been friends with for 20 some years. That 10 years ago, we're at lunch and he's talking about the eventual sale of his firm. And I said, if I were you, I would stop going to networking events and I would stop being involved in bringing in new business. And I would start making sure that you have more partner level people showing up so that they don't think of a guy, they think of a firm. And he's a super competitive guy and an extraordinary wealth manager. And that was hard for him. But he just sold his business for a truckload of money. And I'm not going to say that like he took my advice and that's why he sold his business for a truckload of money. But he did a number of things that made himself a lot less important to the business. He built out areas of the business that have nothing to do with specific wealth management and made the company a real company and not just a practice.
Interesting.
So it's to come back to your question. The first thing to do is sort of look at what do buyers pay for in your sector. right? Like, trying to build your EBITDA, if people pay multiples of revenue in your sector, like let's say you have a software business, it's just as common you're going to get a multiple of revenue as EBITDA. And it might be common that like the revenue, the multiples that people pay for startups that are pre-revenue are huge, and the multiples that they pay for thriving businesses that have profits are small, right? You got to figure out in your sector, what do people pay up for, and start moving toward that goal. And then the other piece is to figure out which things are going to cost you, which things are going to cause people to see risks in your business. Like, there's a guy we were talking to recently that has a super cool business. It's one of the most innovative things I've ever seen, and I had no idea that this even happened. And he serves the retail sector. He's got a fantastic business. I think he does 3 million in EBITDA on 14 million of sales. He makes a lot of money. He pays himself a lot in distributions. He gets regular phone calls. Walmart's 85% of his business. So any outside buyer is going to look at it and go, geez, if the person who makes this decision at Walmart has one cross conversation with you on a Friday, you have what we call silver bullet risk. You're dead Monday, right? So customer concentrations, are a big issue. Like if you have more than 5% of your business coming from one customer, that's going to be looked at as a customer concentration.
Interesting.
Regulatory risks come up, right? Like, this is probably, 12, 13 years ago, but online pharmacies were starting to get some traction. They've since, gotten through a lot of this. But at the same time, my old partners and I, when I was at a private equity firm, were looking at buying this really cool online pharmacy business. There was a senator that was working to introduce a bill to eliminate online pharmacies. Well, if that bill passed, this business was over, right? Doesn't matter what you thought ideologically. If you're a business person thinking about committing capital to that, you're just not going to take that kind of regulatory risk. That happens a little bit more in healthcare and life sciences than it does in most of the other businesses that I work in. But, looking at the things that are risk factors, pretty important.
What about in terms of question? No. What about in terms of you said a minute ago the example you gave where the person that sold their company for a truckload of money kind of did a good job of diversifying, right? As far as looking at other ways to make their business valuable beyond just wealth management. So in that regard, are there things that we can do as business owners to try to enhance recurring revenues, or things that we can do that we should look at to really enhance the overall value of the business? Or should we stick with our niche and kind of our core competency and go that route?
Yeah.
That's a very simple question, right?
Would that I could answer that succinctly. I would say that the most succinct answer I can give you, Ken, is it depends.
Okay.
Look, there are things you can do that add diversification and distract from focus that you might get some credit for, kind of not economic credit, but some credit for that. They will tell your buyer that you're looking at doing a lot of different things, and you're sort of dropping a trail of breadcrumbs for them on what might be the ways to expand or enhance the business. And then there's other things that you can do that, like, I saw a deal, this is now 2.5 years ago. He spoke at a quarterly M&A roundtable that I used to have. And he had taken in capital from a private equity firm to expand his business. He'd been working with the same Vistage chair and coach for 12 years. And this guy was a great student, a great listener. And he incorporated the advice he was getting about not only making his business more valuable, but one of the things he did, he had a packaged consumer good, a food product, that there was an opportunity to do a lot more in online sales and a lot more in non-US sales. And he purposefully didn't do it because he knew the margins would be lower. And he knew that when he went to his final sale, he wanted to give the buyer the idea that, we haven't even tapped international yet. We haven't even started doing all this online stuff yet, because he was making a lot of money and he knew those decisions were going to add revenue and incremental EBITDA, but they were going to hurt his margins. So he would rather the buyer get excited about doing those
The
things.
potential, yeah.
And that's a guts poker kind of play.
Strategic, yeah.
It paid off big time. Big non-US public company bought his company for a truckload of money.
Exactly.
Yeah.
Lots of truckloads of money that are just
Yeah.
riding off in the sunset.
I think if truckload is 9-digit or better.
Sure.
Yeah.
All right, so let's talk about the team, right? So we're all running companies that have obviously varying sizes of employees. Some are marketing, some are sales, some are operations, some are technical engineers. We have a client actually right now on the recruiting side, client back in St. Louis, and we're doing a search for them for a new head of sales, VP of sales, for the greater Midwest area. And we were trying to figure out over the last couple of weeks why things had slowed down. Right, I'm telling the story for a very specific reason, where he had identified a final candidate. He loved this guy, ready to make an offer, but just kind of delayed things. We couldn't figure out exactly why. Couldn't figure out why. Sure enough, yesterday a press release comes out that his company got acquired. Okay, so he obviously couldn't disclose that to us. Probably couldn't disclose it to his team either. Certainly couldn't disclose it to the candidates that we had brought to him that he was going to hire. So my question is, so now things are on hold and who knows what's going to happen with the new parent company. My question is, how do we as owners remain engaged and transparent and honest and upfront with our team, knowing that something might be happening behind the scenes that we can't really disclose to them?
Yeah.
Anybody, does that make sense? That's
Yeah.
something I think about all the time. I run a very transparent business, and Elaine and Vicky know very well what my goals are long term, but you can only disclose so much, right? So
Yeah.
any thoughts around that or examples that you've seen that
Yeah.
worked well?
So I don't think there's a kind of a perfect answer or a science to this. I think it's company by company, but broadly, I would say the more kind of authentic and transparent you are, the harder it will be for you to keep it to yourself, and you should. There should, you need to sort of think about the core team of people who are going to go along with the transaction. So there's you and usually your financial person and maybe one other person in a small company that should know what's happening, and nobody else should, because no matter how transparent you are, those people are relying on you to pay their bills, and they don't know what decisions you're going to make. So some of your best employees are going to freshen up their resumes and start looking, no matter what reassurance you give them. And by the way, if you give them reassurance, you might be creating a legal liability for after the sale. Don't worry, I'm going to take care of you.
Oh, interesting.
Okay?
I've seen that trouble a lot.
Yeah.
Sure.
I'm a consultant with my clients, not myself, but I've seen that. And and then I think you should say again to all of us, keep it to yourself, because like Ken's saying, it kind of is a struggle.
Especially if you're used to running a transparent business.
Yeah, it'll feel, so as Amy said, keep it to yourself.
Cone of silence,
It
as they
will
say.
feel like you're being dishonest with people who matter a lot to you, but you can do more for them after you've struck a great deal, and you will not have burdened them with this really, really seductive secret, right? Because everybody likes to talk about this stuff. And I'll tell you the other thing that happens, it's not just the employees. Sometimes we, the founders, can get really excited about this and not keep our mouths shut. And I was working on a transaction earlier this year. I had two founders, one very kind of locked down, smart, sophisticated, world-wise. The other one thought he was that way, but just can't. I mean, he's a peacock. He just cannot go to an industry conference and not let people know that he's the founder of this company, or that, we're working on this or we're doing that. And he was going to a conference. We had a meeting beforehand to talk to him about what not to say. We had engaged an investment banker. We were almost ready to go to market. He was counting how much money he was going to make and feeling like finally the world sees me for who I really am, right? He not only goes to the conference, but he does an interview at the conference where he talks about one of his competitors in such a way that that competitor, who had dropped a lawsuit against him, found out that he was selling. That he was all of a sudden going to have a whole lot of money. The competitor felt like he had infringed on their patents and decided to drop the suit a year beforehand because it was going to cost him a lot of money to prove himself right. 2 days later, we got a letter from that competitor's lawyer. It now becomes part of the data room. It now becomes a rep and warranty issue. It now becomes a problem that a buyer's got to say, so 40% of your revenue come from selling a product that one of your competitors thinks you copied. That just might be a deal risk.
Could be an issue, right?
So, you know, TBD on that one. I'm dubious about whether that one gets to the finish line. You know, so it's not just our employees, it's us too. We got to be really, really careful.
Yeah.
One of the reasons that I like ESOPs, although I've not done one myself, is because it kind of addresses a lot of that challenge. Because especially if it's an employee buy, we've got long-term employees, and now they all feel more like this is a great deal. This is exciting. I'm going to be participating. Even though there's still a lot of unknowns for people, a lot of people aren't educated on it. Have you seen ESOPs be more effective with kind of transition for long-term teams, well-established teams to work it a little bit better?
Yeah, thanks. So for the virtual audience out there, the question was, you know, have we seen ESOPs work well, you know, to kind of counter some of those things and to be a good alternative? So right now, ESOPs have a really, really hard time competing because there's so much money around that an external sale is usually going to be for a lot more money than you could get for selling to an ESOP. ESOPs typically work best in project-based businesses where outside buyers are going to look at it and say, well, you don't really have recurring revenue. You have, like, if you've got a construction business and you make $30 million, you probably only, you know, and you probably hide your profits. So you only look like you make $300,000 at the end of the year. You start next year with whatever residual is from the $30 million worth of contracts you had, and get out there and do it again. And you've done it for a long time and you've built it up over time and you know how to create it persistently. But an outside buyer looks at it and says, there are not customers that start on day one paying this business any money. They're just doing a project at a time. Well, in a business like that, you know, it might make sense to look at an ESOP. And, you know, and you kind of have to look at what level of debt the company can handle, because, you know, the owners, the new owners, your employees are going to take on an obligation to pay you and or the bank that finances the ESOP. So what often happens is ESOP buys a piece of the business with some bank financing, and the founder keeps taking distributions from the business, develops a successor, or lets the management team kind of step up. And none of that becomes a gating factor on potentially selling the business down the road, you know, if it's still an attractive business. You know, we saw a military, you know, maintenance organization do this, and the founder's a real handful. But, you know, he sold 40% of the business to an ESOP 5 years ago, ended up getting a bunch of huge contracts. And so the value of the business went way, way up. The ESOP gets bumped up on those valuations annually. And they have outside buyers interested in the business. They do a lot of 8A contracts. So they have, you know, it's hard for people to compete with them. So it's harder to find buyers for them. But, you know, we got an investment banker involved who knows a lot about that area. And it'll sell for maybe just short of a truckload of money.
A minivan full.
But he'll be pretty comfy. And by the way, he's already pretty comfy, you know, because he's already taken chips off the table and kind of de-risked himself by selling to the ESOP for part of the business. And, you know, so they can't, it's, you know, it's with ESOPs, it's all kind of facts and circumstances, as opposed to kind of the bigger trends in M&A.
So what's the typical timeline for that ESOP to work its way out to get that founder or whatever to actually say, out? Is that a 3-year, 5-year?
Yeah, I don't know that I'm the best person to ask that question. I would say it takes probably, at least the same amount of time that it takes to run a process and sell a company. So think about, kind of 6 to 9 months, maybe even a year from start to finish. It can be done faster than that, but chances are there's a bunch of stuff that's not quite ready and needs to get ready to be able to do it. But I think as a founder, starting to think about this stuff, and here, look, I'm not objective because it helps my business when people think about this stuff sooner. But as a founder, I think it's important to start thinking about, 3 to 5 years from now, who buys my business from me and what do they care about? And if I can sit here now and say, well, I don't want to invest in my business with the, kind of by kind of deferring my lifestyle for the next 3 to 5 years to be able to do all those things that it's going to, take to make it more valuable, then maybe I start looking at alternatives to that. And an ESOP is probably one of those. The management buyout's one of those where you do a partial sale to a private equity firm. They back, some of your younger partners to buy you out. And then, like I said, I think that developing a successor and being able to take distributions from your business, if you've got a business that won't sell for a lot of money, but produces a lot of economics, which in the M&A world is called a lifestyle business, right?
I like that term, except for I hate the negative connotation.
It's got a lot of
As
negative
if I should,
connotation.
I have a life and a lifestyle. Is that a bad thing?
Yeah.
I still run a business.
But if your business can't sell for a lot of money, but it provides a
Right.
really nice lifestyle for you, then pejorative context
Right.
notwithstanding, it's a
back-
lifestyle
And
business.
back to the why.
Right.
Why do
yeah.
you have this business? Yeah,
Right.
exactly. It's a lifestyle. Yeah.
So in that case, maybe you never get the headline that you sold the business, but maybe you find a way to develop somebody to run the business like you run it. You share some of the economics with them, and you stay involved, but not so involved that you're important to customers and that you can't frustratingly work on getting your handicap lower. It's not going lower, by the way. You're getting older, so your handicap is not going lower.
You just play with the other members that are not as good as you as they get older as well. And so, relatively speaking, you look better.
In that, relatively speaking, take up fishing or something like that. Everybody lies in fishing, but I mean, honestly, I think that there's, and we were talking about this earlier. I mean, there's this fear of missing out that a lot of people are going through right now. And I don't think that a sale to an outside buyer, especially in many cases a private equity firm, is the best exit for a lot of founders.
Yeah.
And that's a whole nother conversation.
No, sure. I was talking actually to there's a big recruiting company out there called ZRG that has been doing a very sizable roll up and buying a lot of firms around the country. They're now about 120 million. And their CEO does a lot of interviews, talks very openly and very vocally about what his goals are to get to about 300 million. So I was talking to, a guy that I know who runs a firm here locally, they specialize in the biotech space. And he had, dinner with the CEO of ZRG back in New York, about a month or so ago. And he said, what you just said, he said, they made an offer to me and he said, the economics don't make sense. I'd have to stay in the business even longer and make less money as far as distributions go than I would if I just kept the business to myself. And I'm at a point now where I don't need that money, if you will. It'd be nice to exit.
And you have a boss.
Yeah, exactly. And you're working for somebody else who says they're going to be hands off, but right, exactly right. That's why we're all here. Yeah, exactly. Yeah. So from a tactical perspective, what are some of the things that we can do? Let's say we all here have a desire to sell at some point. Let's say it's 3 years from now, give or take. What are some of the tactical things that we should start doing to just, whether we sell or not, what we should do to kind of get that structure, that framework in place to prepare for that potential sale?
Yeah. So I think a lot of it is easy to do on your own, which is, research what companies like yours sell for. This is Googleable. And you might not find perfect information and they might not be exactly the same, but, and most of the private transactions that happen don't get reported. Mm-hmm. The reason for that, by the way, is not that the sellers don't want to crow about how much money they made. It's the buyers don't want to admit how much money they paid. So you generally don't see that stuff show up in databases. But try and find out what businesses like yours sell for, and try and find out if there's meaningful, like, kind of gradations on whether you need to be 2x your size to sell for, an 8x multiple as opposed to a 4x multiple, or you need to be 5 times your size to be able to get to that. I mean, if that's reachable in a few years and you'd have to plow money back in, then that's a worthwhile goal to shoot for,
Sure,
right?
right.
And the other piece is, get rid of the Ozzy Osbourne syndrome, right? Find a way to make yourself less important to the business. That doesn't mean so that you can work part-time. Maybe that's a nice byproduct of it, but be willing to let yourself scale by empowering other people to make some of these decisions, because, like, you can be really, really important to the business can be really, really valuable, but your buyer's not going to let you ride off into the sunset, not going to let you, like, even if you do a majority recapitalization transaction where they buy maybe 60% of the business, they're going to want you to stick around. Like, if you're really important to the business, they're going to want you to stick around. And that might mean that you have an employment contract for 5 years. And if you're the kind of entrepreneur who never wanted a boss, believe me when I tell you, you don't want a private equity firm for a boss. They're financial people. They're not operational like you. So they don't speak the same language. They can woo you. But I've talked to very few founders who sold to private equity firms, and I'm not picking on private equity firms. It's just that they tend to want founders to stick around, and strategic buyers don't always need founders to stick around. So maybe the same thing would happen, but generally it only takes about 6 months to where you hate them. And the only reason you keep working with them is because it's in your economic interest to do so. There's 40% that you rolled, if you sold 60% to them, and so you're all moving towards a common goal. But they're not, they're financial people, no matter, even if they do have some operational expertise, right? So you got to kind of think about, what they're going to value.
Sure.
And then maybe lastly, just, kind of be a little bit open to the idea that, each M&A environment is different. And so, unless you're close to a sale sometime in the next 18 months, you might have missed this one. So you don't know exactly what the next one's going to be like. You don't know if money's going to be just as cheap, and whether, kind of private equity type leverage buyouts are going to be the common thing, or whether, strategic buyers, because they can't keep growing as fast organically as they can by acquisition, are going to start outbidding private equity firms again. You don't really know. So just sort of, be open to the idea that, if you solve for the risk factors and build towards the things that people pay up for, that kind of the terms and structure will take care of themselves when that M&A environment shows up.
Okay. Yeah. So in terms of, I'll use a category of kind of shoring up our teams. Do you see any difference in terms of buyers appreciating or valuing a company that has a stronger operational team, a stronger technical engineering team, a stronger sales team? Are there any common areas that we should look at if we are looking to shore up our team?
Yeah, so there it kind of depends on the business. For you, definitely.
Sure.
Right.
I think most of us really are very involved with it.
Professional services
sales,
business. Yeah.
Yeah.
I'm involved in a life science transaction right now where 2 PhD organic chemists developed something that big pharmaceutical companies, big genomics companies, big digital testing companies have not been able to figure out. And these people are going to get 95% of the money at close, have a 5% escrow, and this one's the biggest truckload of money I'm working on right now. It's absurd.
So in that case, it's the technical science.
The science matters a lot.
Yeah,
so the way that they do what they do is the transfer, and the buyer that are also scientists only want them to hang around long enough to make sure that kind of technology transfer moves from their heads to the other scientists' heads, and then they can do whatever they feel like doing. On the other hand, I worked with a small appliance manufacturer, really neat transaction earlier this year. And this guy had listened to around 250 podcasts on people selling their business.
Wow.
And so by the time I met him, he had a lot of viewpoint about how his transaction was going to go.
Yeah. Right or wrong, you have a lot of, yeah.
And but he was, first of all, he's smart, but he's also, teachable.
Mhm.
And so there were a lot of things he had right, and there were some things that he had wrong. And one of the things he had right is that he had hired a chief revenue officer who really knew how to exploit channels he hadn't yet built out. And he hired a chief financial officer who had a lot of expertise in China sourcing and managing multiple suppliers. And so the buyer, he had 11 indications of interest when we went to market, 8 letters of intent. And, we essentially had everybody compete against each other. And then ultimately, in his case, the best offers, there were 3 big strategic buyers who were 2 out of the 4 worst offers. The private equity firms almost all outbid the strategic buyers. The best bid was from a private equity firm that's what's called an independent sponsor, meaning they don't have a fund. They may or may not have a track record. They raise money on a deal-by-deal basis. They were willing to pay about 12% more than the next best bid. And I think the only real significant value I added to this transaction was to do research on the second bid and what their track record was, and research on the guys who had the best bid to say, since you're playing for the second bite, and here he sold 65% of the business and was going to roll 35% and keep working towards that second bite, it was in the databases to see just how good an investor the second bidder was. They had a 14.5% a year average annual return on 4 funds. That's unheard of, right? And so I'd rather that company have 35% of my equity, which is going to be part of my wealth management strategy, than some guys that don't have a track record at all, who just can come up with a little bit more money right now because they have good relationships with investors. And so our investment bankers didn't love us when we said we're taking the second bid, not the first one. But then by the time we got to the close, I think, look, they got it. They were well aligned anyway. They just had a higher opinion of the first bidder than we did.
Interesting. Well, we have only a couple minutes left here. 2 minutes exactly, thanks to Elaine. Any last questions for Kirk, virtually or otherwise? Yeah, Tim.
Just one comment, and I've known each other a long time. I'm Tim, the investment banker he keeps talking to. One of the things that it just echoes what Kirk said in terms of looking down the road to the future is know what metrics drive value in your business. And that's maybe the most important thing to know if somebody's thinking about selling 3 to 5 years from now, because as you mentioned, Kirk, in a project-based business, is there something unique about what you do, something that will differentiate you? The software company, it's recurring revenue. It's a manufacturer, it's gross profit margin, probably not total revenue. So know what the metrics are that drive value, then you can build on those metrics. And that's probably the most important thing for somebody to look at that's thinking 3 to 5 years down the road.
Yeah, great point, Tim. I know Tim and a few other guys like Tim who are generous with all of the reps they have in the M&A gym, who I think of as my decoder rings, right? I get questions all the time that I don't know the answer to. And I'll say, I might call up Tim and say, why would somebody care about doing a stock sale versus an asset sale? And the fact that he was an accountant and is now an accountant in recovery and became an investment banker helps answer that question. It was a good point. Those value drivers are key.
Yeah, I think that's a good point to bring up also. It's a good kind of overarching theme for us because we're all so focused on working in our business and just getting, and it's been a great year for a lot of us, not all of us, but for a lot of us, it's been a very good year. And compared to last year, we're all just like, yay, we're still standing, we survived and we're doing well. But it's still very heads down. It's still a very heads down kind of mentality and approach. And so taking a step back and looking at the metrics that are more industry wide and getting a sense for if we want to sell, what would that look like? What things do I need to focus on that I'm not emphasizing? And maybe some things that I can maybe de-emphasize to make sure that I'm more valuable 3 years from now.
Yeah,
really
absolutely.
Great. All right. Oh, Leanne, yeah.
It's hard to do a broad brush statement between somebody who just kind of does what they think is logical in planning for their retirement and selling off their company versus somebody who engages experts like yourselves to help you plan this and do this well and get the best deal. If you were to go like this really well, is this person getting 2 times more, 3 times more? Like how much better are they going to do bringing in expertise and support and planning it longer term versus reading 250 blogs and doing that?
So I'll try and be quick. I would answer it 2 different ways. One is in the experience I have, the number 1 deal killer is seller expectations. Because they're usually not based in reality, and transactional professionals can help with seller expectations. And I mean, you can argue with your M&A lawyer, and you can argue with your investment banker, and you can argue with me about what your company's worth, in the same way that you think that your house is worth more than your next door neighbor's house because you picked the better bathroom, upgrades. Like, I don't know, your business is worth what the market says it's worth. Doesn't really, the market does not care about what you think differentiates your business. So seller expectation is really critical, and having an advisor is going to make a big difference there. And now I lost my train of thought.
Well, I was just going to say, you can think about it. Well, my thought also is that there's a quote unquote better value on the monetary side. There's also better value, just peace of mind, just knowing that you're referring to and relying on experts that know what they're talking about. Like you said, even a basic analyst at a PE firm has seen 20 times, 50 times more deals than you'll ever look at as a seller. So having those 2 folks on your side, I think, is a good peace of mind.
And I remembered what the second
hoping
point was.
thank you.
Thank you. So the amount of the proceeds that the investment banker gets is probably going to be the largest piece. It's going to be bigger than the M&A firm. It's going to be bigger than your accountant. And in every deal I've worked on in 30 years, I've never seen anybody complain about what the investment banker got. They comment on it. But I think there's your answer, right?
It's a good testament.
If you sell your business for 30 million and the investment banker gets $1.5 million, and you're not complaining about it, it says you think the investment banker did a really good job. You might wish you had it instead, but I've never seen anybody complain about it.
Yeah, James.
Yeah, if you go through the math of the owner and basically come to the conclusion that in their instance, it's not going to make sense to sell. You're 3 years out, and they decide, okay, it's going to succession. It's going to make sense for them. How involved do you stay about that?
Yeah, so we usually do a 3-month consulting project to kind of do what I would call kind of a trajectory analysis, and then step out and let them go for a year and remain open to the idea of coming back in for another 3-month contract, or even just a quick 1-month kind of check in. Yeah, but we don't, I have 2 clients that have retained me for a year at a time, and a 3rd one that just retained us for a year, plus they want us to be on their advisory board. We get a little bit stretched because my resources are mostly what I would call kind of distributed, and they're not really high, kind of professional level. They're more support staff. So there's only so much, kind of we can do, and there's only so much value we're going to add. We don't add operational value to your business, so the trajectory analysis is critical. But I think the biggest mistake people make sometimes when they work with a management consultant or any kind of consultant is think that the guru part of what the consultant imparts makes you all of a sudden think, my God, I got to have this person involved in my business, and understand that the guru part, only lasts as long as it takes you to learn what the consultant knows. And then you're even, right? So when it comes to executing on the consultant's advice, you're going to be just as good at that, maybe better, without the consultant's distraction, right? Because you want to execute. You don't want to keep tinkering with the plan. You want to execute.
That's a good point. All right. Well, thank you very much, Kirk. Please, everybody, join me in thanking Kirk. That's great. Great conversation.